Hi everyone, thanks for joining us for this Horizon event that's presented by Lenovo. I'm Olivier, Project Manager at Zoo for Programs and Corporate Innovation. Horizon is a conference series that aims to shed light on tech, on creative industry trends. We're grateful to Lenovo for making these great conversations with entrepreneurs come to life. Today, we're happy to present a panel on startup investment with some seasoned venture capitalists in the creative industries. We have Troy Vossellor, co-founder of gener8tor, a nationally ranked accelerator that invests in high-growth startups in the United States. And we have David Dufresne, co-founder and venture partner at Panache Ventures, the most active and best performing Canadian seed stage venture capital fund here in Montreal. Now I'm passing it on to the moderator of the panel, Carmen Duville, who is Director of Ecosystem Development at Mars Discovery District, which is an organization that also helps startups grow in the Canadian landscape. Thank you and enjoy the panel. And Carmen, it's off to you.
Thanks, Olivier. Welcome to Investing with gener8tor and Panache Ventures. Thanks for joining us today. Over the next hour, our panelists are going to share their respective experiences with investing in startups, their selection process, key challenges and takeaways, and the importance of creating a tight-knit community of daring entrepreneurs. Investing in startups is no small feat and demands patience, determination, and above all, a commitment to community and diversity and what facilitates success. We are sure you have an array of questions, so please feel free to share in the comments section for a later part of the session. But first, let me share a little bit more about these two remarkable individuals who know how to navigate the uncharted waters of capital venture and support the growth of growing startups. Troy is the co-founder of gener8tor, a turnkey platform for the creative economy connecting startups, founders, musicians, artists, investors, universities, and corporations. The gener8tor platform, which includes pre-accelerators, accelerators, corporate programming, conferences, and fellowships. gener8tor operates more than 40 accelerators annually across North America, working with more than 200 entrepreneurs per year. No small feat. David is a venture partner at Panache Ventures. David is truly a pioneer in the Canadian VC industry. He started his career in the VC industry in the early 2000s at Desjardins Venture Capital and the Blackberry Partners Fund. David left to pursue entrepreneurial roles and acted as the CEO of music tech company Bandzugi for 5 years. He recently worked with music platform Bandcamp as their head of strategy and growth before returning to VC. David is a sought-after speaker and panelist at many venture capital, tech, and entertainment industry events. He acts as a mentor and advisor to many startups, accelerators, and incubators across Quebec, Canada, and the US. But first, we want to hear a little bit more. Troy, can you tell us about your personal experience with venture capital and a bit more about gener8tor and more?
You bet. Yes, and hello everyone. Good morning, good afternoon, and thank you to Carmen and the rest of the team hosting today's conference. I have some slides prepared to give folks in attendance a little overview of all the great things that we do at gener8tor. To start, I'm one of the co-founders of gener8tor. I got into this business as a lawyer. So in law school, I realized that I really enjoyed kind of this intersection between both the law and entrepreneurship. And in working with startups that were raising venture capital, myself and my soon-to-be business partner, we realized that there just lacked a lot of efficiency for an entrepreneur to go from idea to incorporation to growth to raising venture capital. And we wanted to find a way to make all that much, much more efficient. And so in parallel, we had been admirers of the accelerator model. So starting with Paul Graham and Y Combinator, and it dawned on us that, hey, what if we started an accelerator here in our hometown? And so I'm based in Milwaukee, Wisconsin. And that's what we did starting in 2012. I always like to start with our mission. Our mission at gener8tor is we want to be the best partner for a community to invest in its best and brightest. And we do this via our gener8tor platform. So what started 9 years ago just as a startup accelerator program has spanned across 5 different unique product lines. So on the next slide, we talk about everything that we do from the pre-accelerator era to our flagship accelerator programs. This is a venture capital fund model where we're actually investing cash in exchange for equity. We do a lot of work with corporations, in particular, helping corporations stand up, create, and grow their corporate venture capital and corporate innovation platforms, as well as a conference series called OnRamp designed to connect corporations and startups. And I'll talk about an example relevant to the entertainment industry. Fourth, we do a lot of work in the culture space, and I think that's very apropos to this conversation. But about 2 years ago, my business partner and I, we took a step back because we had been working exclusively with tech startups, but we asked ourselves, what's a category of entrepreneur that we think is particularly underserved? And so we decided to experiment by adapting the accelerator model, which in my opinion has been very successful for tech entrepreneurs or kind of more stereotypical startups. But what if we applied that to a different type of entrepreneur, in this case, artists and musicians? And so we stood up a handful of programs. One is called gener8tor Music, an accelerator for musicians and bands. The second is called gener8tor Art for visual artists. And then most recently during COVID in particular, we started experiencing work with a lot of un- and underemployed individuals. And so we created something called gener8tor Upskilling in the workforce development space to do digital skills training for these individuals to help them get new or better jobs in the kind of digital environment. On the next slide, we try to be very statistics oriented. So I mentioned we started in 2012. Today, we operate 45 different accelerator programs across 25 cities. We're in 13 states and provinces and 2 countries, so both the US and Canada. Across those programs, we've worked with more than 500 startups. Combined, they've gone on to raise more than $500 million in follow-on financing, and they employ more than 5,000 people. We also publish all of our statistics around follow-on funding, as well as diversity, equity, inclusion on our website. So you can go to gener8tor.com statistics and see all these numbers. I mentioned that we're across North America. So this is a brief map showing all the different locations that we're in, everywhere from Alaska to Puerto Rico to a location in Toronto, Canada. So that being said, our focus very much is on markets outside of Silicon Valley and New York. And we think there's a lot of commonality in those markets, both in the creative industries, but also in the more traditional tech industries as well. We've been the most active investor in the Midwest. So when we look back, and this is PitchBook data, when we look at all the investments that we've made since our inception in 2012, we take a lot of pride in being very active, a very high volume investor. And that has earned us some recognition. So for the past 4 years, gener8tor has been ranked amongst the top 15 accelerator programs in the United States by a group called the Seed Accelerator Rankings Project. And then most recently, we were named to Fast Company magazine's list of most innovative companies. And this is specifically for the category of music. So they looked at the adaptation of the accelerator model towards musicians and artists that we started 2 years ago. And that's what we were recognized for. A couple of our programs that are specific to the creative industries. We run a program called G-Beta Music Tech. So this is an accelerator program exclusively for music technology startups. You can learn more by going to gbetamusictech.com, which is on the screen here. This is a partnership with Capital Music Group and Capital 360. And during normal times, we operate it out of the Capitol Records Tower in Los Angeles. The second event is our OnRamp Entertainment Conference. I mentioned earlier, when we work with corporations under this format, the idea is how do we create a one-to-one pitch environment for startups to meet with corporations? So at the OnRamp Entertainment Conference, we get dozens of entertainment-focused corporations, as well as VCs, who agree to take meetings with startups from around the world who apply for this free opportunity. So how it works is startups can go to this website. We don't quite have the dates yet up for this year, for 2021, but soon they'll be up there. Startups can go, they can apply, and then corporations and VCs get a chance to review that list of startups, select the startups that they want to take a meeting with, and all that happens virtually, or has been happening virtually, but hopefully eventually we'll get back to in person. The next, during normal times, I should point out, these OnRamp conferences tend to take place at sports stadiums. That's kind of become our trademark for the event. This is an example at Soldier Field in Chicago. And at this one-day event, again, there's a full day of conference programming. So we have keynote speakers and panel discussions all about the entertainment industry, and specifically tech and startups within the entertainment industry. And then from that are the one-on-one meetings, what we call the startup track. We can jump one after this. I alluded to our culture program. So I think this is an area that makes us somewhat unique as an accelerator or as a venture fund, in that, we're not just focused on the startups themselves, but we're also working with the underlying artists and musicians and creatives within this industry. So that's both our Generator Music Accelerator and our Generator Art Accelerator programs. On the next slide is just an example where you can learn more, just generatorart.com. Again, this is an accelerator for visual artists. Artists receive between a $15,000 and $25,000 grant that we go out and fundraise. In these programs, we don't take any equity. We don't have any royalties or residuals. It's purely designed from this notion of kind of creative placemaking. How can we help these artists grow in their careers, and taking a very much a business perspective on that. On the next slide, we talk about our Generator Music program. Again, similar model. It's a grant-based program, grants of between $15,000 and $25,000 that each of 5 artists receive. You can learn more at generatormusic.com. But the purpose of both of these programs, and kind of how it ties back to the work that we do in the creative industries, is that by us being exposed to the underlying artists, I think it informs the work that we do when we're making those investments, for example, in our music tech program or in our Generator Accelerator program. So we've had a number of instances where we've been able to get artists that we've worked with on the artist side to collaborate with startup founders and CEOs on the tech side. And I think that's really a special sauce. This slide here, as an offshoot of our work in the music industry, we do have a partnership with Motown Records and Capital Music Group and the Motown Museum, where we have the Motown Accelerator. So this is just another version of our Artist Focus Accelerator, but is focused on the Detroit market and the rich history and partnership with the Motown label there. So that's a brief overview of Generator, and I'll pass it back to you, Carmen.
Amazing. Thanks, Troy. Remarkable work that Generator is doing. David, can you tell us a little bit more about your personal experience with venture capital and more? We'd love to hear more from you.
Well, right now I'm just wondering how Troy finds time to sleep, and honestly very impressed by the breadth of what you guys are working on and all the programs you have going on. I've been part of some of the conferences and events, and I can testify it's an extremely well-run organization, and been an interesting source of deal flow. Yeah. So about me, I grew up in beautiful and scenic Trois-Rivières. Grew up as a kid playing a lot of soccer, but also listening to a lot of music. Always been a big music geek, and ended up doing my master's degree, did a research project on venture capital, and that was in the late 90s. I'm dating myself, but late 90s, so the first internet bubble. Learned a lot about how innovation was getting funded, and that led me to, like, after going to work in Australia for a little bit, I came back, moved to Montreal, and started working in venture as an analyst at Desjardins. Then went on to work for a Toronto firm that was then called the BlackBerry Partners Fund, investing mostly in mobile applications in the first early days of the app stores. And then I wanted to launch my own startup. I ended up joining an existing music tech startup named Bandzoogle as their CEO, and for me that was great because Bandzoogle it's still a fantastic company today, and it's a suite of tools that allow bands and musicians to build their website, their online store, their presence, to manage their mailing list. So a mix of commerce, marketing tools, and a very strong team. Like many tens of thousands of bands and musicians today use it. So that was a great adventure, and for me, it was great because it was all my passions, right? Technology, business, music, all in one. And we grew the company organically without taking any venture funding. So maybe that should be one of your questions, Carmen, or folks in the audience. And that led me, after 5 years, ended up joining Bandcamp, which is, as many people listening in will know, but Bandcamp is a mix of a large marketplace for independent musicians and labels, with a discovery platform for fans, an editorial site also that's kept growing since. And then I came back to venture as a partner in the 500 Startups Canada Fund, which morphed into Panache Ventures. And today Panache Ventures is probably the most active seed and pre-seed stage investor in Canada. We have offices in Montreal, Toronto, and Calgary. We've done over 80 investments in the last 3 years, some of them in entertainment-related technology, but a lot of them in other fields like digital health, fintech, cybersecurity, real estate tech, So it's very broad. We mostly invest in Canada, but we've made investments in the US as well, and we've made one in Israel. And on the personal side, I'm also a angel investor. So I've invested in some music and entertainment related startups. Like recently invested in Arcadia Games. I'm an investor in Sidedoor. It's a network for matching independent musicians and promoters that want to have concerts in non-traditional venues. I'm an investor in Circular. It's a Spanish startup building a new kind of headphones, and a few more, either through Panache or personally. And also a board member at Pop Montreal, which is a local festival that's in its 20th year. So that's been an interesting adventure as well. So that's the short version. Happy to answer questions if people want to learn more about my experience. Back to you, Carmen.
Amazing. Thanks, David. I mean, you both have very different histories, very different experiences that have brought you to where you are today. Like, how has your respective experiences, influenced your investing in startups, and what would you define as your ideal scenario when it comes to investing?
Yeah, I can start by speaking a little bit to. I can jump in and speak a little bit to kind of how the creative industries got on our radar. Really was very rooted in the community. And I think obviously what's going on with Zoo in Montreal is a really special ecosystem there. And I applaud Quebec as fostering that type of culture. But in a lot of the markets that we're in throughout the Midwest United States, I think there's kind of this belief that we don't own tech. That's a Silicon Valley thing, or that's a New York thing, and we don't own culture. There's nothing really unique about that. And I just find that to be it's kind of self-defeating. And so when we think like more broadly about economic development and how do our communities grow, I think so much of it is rooted in culture. So let me give you an example. If I'm a big corporation and I've been around for 100 years and I'm employing tens of thousands of people in a specific city, I think too often they think about, well, it's just about, what's good for me as a corporation. And the reality is most of those job offers are a commodity. So if I'm a corporation, I'm trying to hire $100,000 salary software developer, which is kind of the most common title that any corporation's hiring today. How do I recruit those people, or how do I retain that talent in my city? And I think so much of it comes down to culture. And I mean culture in two things. I mean economic dynamism, meaning we want to make sure that we have new startup businesses in our community that are eventually going to become those Fortune 500 and become those big employers with 10,000 plus employees. And so we need to make sure that the legacy institutions, the incumbents, whether it's on the government side or the private industry side, aren't suffocating kind of the new growth coming up through. So that's important, I think, on the startup side. And then on the culture side, I think oftentimes when people are evaluating a new job or a new career, it comes down, again, I think the job offer is a commodity. If I'm a technologist or a software developer, I can probably get a job offer in any city in the world. And so it becomes, why do I want to live in that city? And I think those factors come into what's the music scene like? What's the, what types of art experiences or galleries or museums exist in my community? And then becoming more progressive, what are the experiential activities that happen? And so this is where I think there's this sweet spot of where the creative industries are kind of bridging that gap between new startup creation, economic dynamism, and fostering a culture, in particular, engaging with artists at the local level. And if we can do more of that, I think our chances as where I live is very much a secondary, tertiary city. How can we remain relevant? And so the likes of, New York and Chicago and Los Angeles and, other markets can't cannibalize us.
Yeah, I'd agree with that. I mean, relevancy and kind of like what is the quality of life, and culture is kind of really at the center of a quality of life in many respects. David, what is your thoughts?
Well, I agree with everything Troy has said, and I think there are a lot of parallels to be drawn between Canada in general, and then within Canada, markets like maybe Montreal, Ottawa, or Edmonton, Halifax, like a lot of parallels. And Canada is probably seen as a tertiary market if you look at the global scale. but has been above to punch above above his weight class recently, partly for many of the reasons you described. Like the culture is important, drawing talent and immigration to our cities and schools. But then having one, I think, unique advantage we have is there's a lot of government support and non-dilutive help for early stage founders and startups. And then we're seeing more of the private capital plus talent coming back into the ecosystem and creating kind of the conditions for success. So lots of parallels between like the Midwest and Canada as far as markets are concerned. But to answer your earlier question, Carmen, I think like for me, the perfect opportunity to invest will be, a founder team that is working on a big scale problem in their specific industry. Like they're being very passionate about the problem, looking to solve. Coming to market with a solution that is unique, that is innovative, that is defensible, so that they can build it and keep their advance over competition over time in a large addressable market, so that it can lead to venture scale returns if it is able to grow and scale. Led by a team that is, like, I always ask myself, why is this team going to win at this, like at fixing this problem and building this solution to market? And then also the deal has to make sense. Like it has to be the right time for them to raise money. I always look, because we've been a small team working with a large portfolio, the co-investment syndicate, like who are we going to work with? Who else is going to be involved in the company? So if all of that is aligned and works out, then there's a good chance we're going to be part of the adventure.
Brilliant. Yeah, scalable markets. You both brought up really interesting points, kind of at the intersection of like culture and tech economy. And I think we can all agree that starting a business in many respects is the same across the board, industry, cluster, product. Yet startups in the creative industries do typically face additional or sometimes different challenges, especially when it comes to attracting investment. Like, curious as to what specific advice do you have for creative industry based startups looking for investments?
Maybe I can go first on this
David?
one, because I've I've made I can go first. Because I've made a lot of investments in the creative industries and outside of it. I think where creative industries are different is that often the mechanisms for funding productions, or I don't like the word content, but like if you're like funding one movie production or one video game or one TV series, like often is project-based financing, versus the rest of the venture capital world is like you're funding companies, right, and startups for the long term. So one challenge is often someone that comes from one of these industries, from the movie industry, say, like is not familiar with the type of funding that sometimes is needed to have those conversations and speak the same language as traditional venture capitalists. So that's one challenge I can identify. And then the business models can be very different, like depending what industry you're in, depending, are you building something to enable creators or to bring creations to an audience? Do you have to deal with licensing? Like there's a lot of questions that are very specific to some of the creative industries, and that might scare away or turn off investors that might not have the specific expertise. And I'm going to let like a good example of someone that has that expertise follow up on this, because Troy has that focus.
I love the analogy of like, are you a movie studio or are you a movie, right? Or, are you a TV show or are you a TV network, right? And I think, so I think that's important for startups. Not that one is better than the other. I think you just need to be self-aware of what you're doing. Like when you're pitching, is it a project-based thing, which will have its own sources of financing, versus are you building a platform-based technology, for example, which is going to have a different path and perhaps more eligible for a venture capital financing path. One area that I think sometimes the creative, speaking of tech startups in the creative industries, I think sometimes they, and this is like a blessing and a curse, they're almost creative or artistic to a fault. And sometimes I think they want to rest their hat on the fact that this is creative for the sake of creativity, or this is art for the sake of art. When the fundamentals of business, I don't think change. At the end of the day, if I'm investing, if I'm not issuing a grant, or if I don't have programmatic funds for what you're doing, I still need to see that underlying business model, like David said. I still need to see a path for return. I still need to see a large and growing market. The line I like to use is prove that the dog will eat the dog food. If you have a great piece of technology relevant to the creative industries, it's one thing to just say it's a great idea. It's another thing to say, hey, this is a great piece of technology for recording studios. And here's 12 recording studios that are now using my software, for example. So just prove that. And I think sometimes, again, entrepreneurs in the creative industries kind of lose sight of that, or they get kind of too bogged down in product, or I call it the creative side of it. But we need to make sure that the business side is front and center. And so focusing on fundamentals like how many customers do you have? How much are you charging them? Therefore, what's your revenue? And then growth, how quickly are new adoptees, glomming onto this new technology. So I think being very much focused on that. In some instances, there might be a really niche area that you're focusing on. If you're focusing on software for a specific type of mixing board, well, that might be by its very nature a very small market. Again, it's just a matter of being self-aware. You're not going to get the same valuation as Uber, right? And so you just need to have a different perspective, a different framing, that if the market size is limited, and I'd encourage you to do a total addressable market exercise, meaning if you sold to 100% of eligible customers that you've identified, and you multiply that by how much you're charging, that's your total addressable market. So just being self-aware of that and realizing that, hey, if you're doing something that's super niche, that can be a great business. It can even be a venture backable business, but it's probably going to mean you're not raising as much, or the valuations are lower, or the pool of interested investors is going to be smaller. So again, I just think being eyes wide open about all those different variables is important.
Brilliant. Something for everyone to put in their notebook: prove that the dog will eat the dog food. Thanks for putting some context and some incredible insight. Project versus scalable products and platform. David, you also spoke about valuation. I guess starting with you, how do you conduct your selection process? How do you determine which startup to invest in or not?
Well, the criteria I mentioned earlier, is all true. The perfect pitch is there's a big problem out there that a lot of people are going through, or there's a big, unoptimized situation that we've found in industry, or there's a big innovation that doesn't exist that should exist. We've built a solution to that problem and that innovation, and we've made something that's unique and defensible, and that pretty much no one else or very few can make. We know how to bring it to a large market. We know how much to charge our customers. We've validated that they want and need it. We have the perfect team to do it. Because we understand a lot of stuff that the rest of the world doesn't understand, and because we have a good mix of the technology, the business savviness, the design and interface talent to make it happen. And then we need to raise some capital, but we're going to raise it with the right investors, and we're going to bring this to market. And we have a clear plan over what to do in the next 18 months with the capital that we're raising today. That to me, if I check mark all of these points when you're pitching me, and the meetings we're going to do after, then the likely that this is going to be a deal for me or for my firm is pretty high. I'm not saying it's easy to hit all those points, though.
Yeah, just a small list.
That last point in particular, I think, is important because, entrepreneurs of any kind, whether you're the next Uber or, something more niche in the creative industries, the most likely reaction you're going to get from a potential investor is a no. It's a rejection. Just empirically, that's true. And I think just making sure that, again, that you're self-aware and eyes wide open about that. You need to be pitching a lot to find that appropriate investor that's going to really jive and appreciate and be in that strike zone for you, for your company, and for what you're doing. So I think that's a really important perspective. On our end, we operate via the accelerator model. So we kind of have two different models within that. One, we run what we call free programs, where we rely on corporate sponsors to facilitate the overhead and the expenses that go into it. In those programs, we're not actually investing cash into startups, and we also don't take any equity. We don't charge any fees. It's purely a free program where our hope is that our team and our network of mentors and corporate partners and customers and investors can help you as a startup grow. So for example, that G-Beta music tech program that we run in Los Angeles for music technology startups, that's a free program. So again, we're not investing, we're not taking equity, but it's still a competitive process. So our team is out recruiting startups to apply, startups apply online, and then we narrow that down to about 5 startups at a time. So we call that our concierge approach. We only tend to work with 5 startups at a time. And for us, that's about just providing them a much higher level of service, perhaps than some other accelerators that work with, 10, 50, or, YC is doing 200 plus companies at batch now. So that's been our differentiator in terms of the service that we provide as an accelerator. Our other model is our equity-based, or what we call our flagship model. For that, most of those programs are industry agnostic. So we encourage startups of any industry, any business model, and any geography to apply to those programs. Those are epitomously named under our gener8tor brand name. In that case, we are investing $100,000 in exchange for a small piece of equity. But it's a similar process. We are recruiting startups apply online, and then our team is narrowing that down to typically about 5 startups per program. To put some of that in perspective, we get about 1,000 applications per program on that the equity-based model that I just described. So it's certainly a competitive process. And this goes back to my line about prove that the dog will eat the dog food. The more you can stand out by showing that traction, the better. Because I'm not an expert on it. I don't know much about anything. I'm not an expert on anything. But if you tell me that, hey, I'm building this widget, and not only is this widget a great idea and here are all the technical specs behind it, but here's the list of customers, or here's the revenue that I'm generating, or short of that, here's a letter of intent, or here's our go-to-market strategy. The more you can explain that traction or a proxy for traction, the better your chances with us.
I mean, Troy, you brought up something that I think every startup likely fears, and it's hearing the word no from a potential investor. I mean, are there common mistakes to avoid, whether it's like a pitch or otherwise, or examples that you've seen that you've kind of just put your palm to your head, or things that you think that startups should be thinking about?
Yeah, one piece of advice I'll give you 2. One, I'm very biased. I run an accelerator. I think accelerators are a great option for some entrepreneurs, for some startups. So if you're at all thinking about it, I encourage folks to and you can browse accelerators on AngelList. They have a great platform for accelerators. GAN, the Global Accelerator Network. So that's GAN.co. I would check all their member lists of international accelerator programs. So I think accelerators are a great option. That being said, if your traction, your market, your team, your credibility, et cetera, justify you jumping directly into a seed round or working with a VC or an angel group, by all means, you should do that. And so that leads to, my second piece of advice is, I encourage people to take a shotgun approach versus what I call a lazy river approach. Too often what I see is a startup CEO say, well, here's the one investor, or here are the 2 investors that I want more than anyone. And so I'm going to spend all my time trying to get on their radar, or trying to get that warm introduction, or reaching out to them cold and scheduling an opportunity to pitch them. Again, going back to the empirical evidence is that they'll probably ignore you, or you won't be able to get that pitch. And so by waiting to do that, you're losing a lot of time. Your burn is happening no matter what. And so my advice to startups is to maximize or optimize for optionality, which is, apply to many accelerators at once, reach out to dozens of VCs at once. Now you should qualify that. You shouldn't be blind about that. You should qualify who you're reaching out to. But as long as you're reaching out to a qualified potential investor, whether that's an accelerator, an angel, or a VC, I encourage people to do that within a pretty tight time frame, because what you don't want to do is just say, here's my favorite number 1, and maybe they take 3 months before they ever get back to you with an offer, and maybe they don't make you an offer, in which case you have to start that process up again, going down your list. And that's what I mean by a lazy river approach. I just find that the more you can create, kind of call it FOMO, call it increasing the buying temperature, get stalking horses. Again, no matter who makes an offer to you, the fact that you have an offer probably subconsciously gives you a confidence boost when you're talking to investors that you prefer. And similarly, now you can say like, hey, you've gone from a 0 to 1. In instance 1, you have no offers, and so the train is in the station. In instance number 1, you have at least one offer, and now the train is leaving the station, and I think that makes you much more compelling as a potential investment.
Couldn't agree more. David, do you have anything to add to that?
Yeah, absolutely. The most common mistake I see entrepreneurs make is try to raise venture capital when they shouldn't. It's not for everyone. Like the majority of startups in technology will not raise venture capital. It doesn't mean that they cannot be great companies. It doesn't mean that they cannot grow. It's just that, like, venture capital is maybe it's a bad analogy, but it's like putting nitro in your car. It'll go faster, but it might you might want to strap your buckle for the ride. The car might blow up, and at some point when it stops, it's gonna hard. So if you're in a Troy explained earlier, like the addressable market, if you're in an addressable market that is too niche, which limits how you can scale, there might still be room to build a fantastic business. But I would look at alternative ways to fundraise, either through maybe sometimes angel investing, to non-dilutive vehicles, to just bootstrapping it yourself and trying to get revenue as soon as you can. Revenue is the best fundraising you can ever make. So that's the question you need to ask yourself, but also what you want to do. Like often I'll ask founders, like, maybe it's a trick question, but I'll ask them, like, where do you see this company in 5 years? And if the answer is, well, we'll grow from 2 to 50, and then I think Google is going to acquire us for 20 or 30 million, I'm going to say that's great, go do it, but stop talking to capitalists like me, because that's not the type of investments that we look for. Or do you see yourself going from like a team of 10 employees to having 250 employees in 3 years? Because that's a whole different ballgame. It's whole different ways to spend your days as a manager, and it's not for everyone. So biggest mistake is startup trying to fundraise venture capital when they should be looking at other ways to grow their company.
I love that, David, and that reminds me of I'd put a plug in for crowdfunding in some instances. People have pros and cons about crowdfunding, but if you're a niche product and you have a very robust, enthusiastic market of customers that maybe they're all on the same small Reddit group together, or they're just they're buzzing back and forth about what's going on, I actually think that's a perfect use of crowdfunding. Because if you have a customer base that's just rabid about their industry or their niche or what you're doing, what your product or service is, I actually think that's a really good use case for crowdfunding. Meaning, let's get those people who are the most excited, who are best positioned to determine if what you're doing has value because it's what they do. I think you should consider crowdfunding. And you look at the platforms like Republic or Seed Invest, they've really become more robust. In the US, the limit is now $5 million if you're fundraising under what they call Reg CF, and you meet certain criteria. But point being, I think it's something that I think it used to be kind of, poo-pooed from the venture industry. But again, I think if you're the right niche product and these platforms have gotten much, much more robust and the communities behind them are more robust, I think it's something you should consider.
I agree with this 100%, and I'll add to it that even just angel investing is becoming more and more accessible to people that maybe have never invested. So we're seeing this unbundling in venture capital, whereas different models that are like crowdfunding is definitely part of it, where that could make more sense than the traditional raise from a VC firm path that has been in the media so much.
Have either of you seen a crowdfunding example that's just remarkable? Does any kind of come to mind and blowing your mind into a million pieces?
Yeah, I mean, one that just happened on the Republic platform was Arlen Hamilton with Backstage Capital. So, her platform is designed to focus on underrepresented founders. And I think that's a perfect example where there's such a focus and an interest group and a community around that it just went viral because, she talks about how she's going to open up, people can invest into her management company via Republic in a crowdfunding manner, and they can invest as little as $1,000. Well, that's I think a perfect example where the community makes it go viral. Everyone's sharing it, and they're proud to say, I'm putting in $1,000 because I believe in this mission around diversity, equity, and inclusion. So that's an example where if you can align the mission and just the tight knitness of a community, and if it speaks to the niche, meaning in her case, her argument is a lot of underrepresented founders, when people talk about raising a friends and family round, they don't have friends and family that can write, $100,000, much less $1 million check. And so I think that really speaks to this notion of, well, now I can invest as little as $1,000 into this cause and this business that I really care about. So I think that's a really good contemporary example. I think she raised $5 million.
I was going to add, I've also seen,
Go ahead, David.
I've also seen startups successfully use crowdfunding platforms when they're making something that people buy, people want to have. Sometimes they'll use a crowdfunding as a seed investment and might raise venture funding later. Like a good example I can think of is one of our portfolio companies named Wolf and Grizzly. Like they make camping equipment. Like their main product is a super lightweight grill and fire pit that you can fold and put in a backpack when you go hiking or canoeing or camping, and did a really good job setting up a Kickstarter campaign, like raised their, I don't remember how many hundreds of thousands to get their first production done and delivered. And then they were in a good position to go and raise venture capital. So it's easier when you're raising from the public, when you have a goodie they can, have in their hands at some point. But I agree that more and more crowdfunding is becoming interesting for startups that cater to a niche community that might want a product that might be software, that might be something else than a physical object.
Yeah. And that's a good point, David, where it's not mutually exclusive. If you have a super successful crowdfunding campaign, well, now you might have gone from a niche to something that's much more mainstream, and maybe your next round of financing is appropriate for venture capital. And in some respects, your crowdfunding campaign is like a commercial. It's like a billboard for what you're doing to the venture community. So it's not mutually exclusive.
One mistake to avoid, though, is like having raised on a crowdfunding campaign, having to deliver like 200,000 of these fire pits and not having the money to do it. Like investors are allergic to these rounds. But if you've been able to get your production in order and your bill of materials and your production's underway, then you're a lot more credible.
So watch out for that pitfall or that fire pit. Ha ha ha. I mean, the essence of time has come up in a few ways. Like, where do you see your company in 5 years? Reach out to multiple accelerators and investors so you can kind of get that ball rolling. But I mean, if you were to make one prediction in the next 12 months, what do you think angel investors and VCs are going to be looking for? Troy, you seemed really, really excited about this question.
Where are they going? I'd say the reality is there's just so much new money that's out there. So new platforms, whether it's like AngelList syndicates or like crowdfunding platforms like Republic, but you even just look at traditional venture funds, like they're raising more and bigger funds, and meaning there's just more money available. If anything, I think let's view that through the lens that I think that's a good thing for startups. Although if we go too far in the perspective, I do worry a little bit about like how can all this money produce returns that justify it in the first place? I think that's going to become increasingly difficult. Now that's more of a problem on the VCs to figure out. But for you as a startup, I think the reality is it's always difficult to raise capital. I want to be empathetic to the reality that it's always difficult to raise capital. That being said, there's more money available than any other time in human history, and the vehicles, whether it's crowdfunding or AngelList syndicates or traditional venture capital or accelerators, there's just more of it in general. And so to the extent it's always been difficult, it's a little bit less difficult perhaps today, and use that as some motivation to say, okay, now I want to pursue the strategy where I'm just going to qualify all the potential types of investors that might be a fit for me, and I'm going to go out and do my best to try to pitch and raise that money.
Super cool. David, do you have to add to that?
Yeah, I'll add that you probably want to be careful. Like lately, I've been getting nosebleeds just from seeing the valuations that are getting thrown at startups that are still very early stages. And Troy is right that it's a problem on the venture capitalist side or an investor side, but for founders, it can also become a problem if they've raised at a valuation that, and raised gave them 18 months of runway. You have 18 months to grow into a multiple of that valuation. And when you don't, then it becomes tricky and you can quickly lose control of your company. So yes, but you still want to be careful because I agree there is capital out there, a lot of large funds that need to get deployed in good startups, and investors right now are all looking at investing in what a post-pandemic world looks like. And that I think for the crowd here, the future of entertainment, like now that we've all spent a year, most of us, stuck in our homes or not going to events, like what does it mean when we go back to a world where there are events, but maybe hybrid events or events I might have to plan for going back online? Like there are a lot of questions, and that, the same themes can be seen in the future of work and the future of real estate, in the future, obviously, of medicine and digital health. So yeah, when you're having conversations with investors, try to focus on what your vision of the new and future normal looks like and where your startup and your technology fits into that.
Mm-hmm.
And keep in mind that work from home is, I think, a good thing for most startups that aren't in those traditional tech hubs. Our fund itself has invested in at least 30 startups in the last year, and we haven't physically met any of those founders. And so I think that's a benefit where, used to be you had to go to Silicon Valley, or you have to be within 90 minutes drive of your VC, or, there used to be all these rules of thumb that have totally been thrown out the window. This is a great thing for startups in emerging markets and cities throughout the world.
Thanks. Yeah, I mean, we've probably a lot of people in the audience who've been working in isolation and have a million questions they want to ask you. So maybe this is the perfect time to jump to the audience for questions. So Olga has a great question, which is now being covered by a toggle for me. But what recommendations do you have for startups in the creative industries that are not tech? Do you believe they still qualify for venture capital? I mean, David, I think I'm going to throw this one over to you because you've probably seen so much of both come through your life.
Tech is often, so most or the majority of startups that raise from venture capital have a strong tech element, because it is usually where their defensibility comes from. Like both the innovation, like whatever they're bringing that's making their market like 10 times better or 10 times cheaper or faster. Usually there's an element of technology. It doesn't need to be technology. It could be a brand. It could be a media product that is unique, that is low on technology, but you want to make sure that whatever you're bringing to an industry and to investors is both scalable and defensible. So you might not be talking about intellectual property or how your quantum computing technology is well ahead of the others, but you might want to talk as to why your team is going to create this new brand that will resonate quickly and strongly with a particular generation or a particular market. Or you might want to talk about the network effects of what you're building and how like one user, one consumer for your product is going to bring you 10 more. So it's harder, but it's not impossible.
Great.
And I think a lot of it's just, qualifying, like what source of funding should you go after? Because it's not just venture capital. There's many sources of financing available. That being said, I think to David's point, a brand can break through and become venture backable. In the US, Shark Tank or Dragon's Den, the TV show, I think at one point in time, their most successful company was Tom and Chi, which was a chain of grilled cheese and tomato soup restaurants. That was one of their most successful financial investments. And that's not tech, right? Grilled cheese sandwiches and tomato soup is not tech, but it was still a great business. So this goes back to the fundamentals. If you can get customers and you can get customers at scale and you can get customers at scale with margin and you're growing, then tell that story and let's see what happens.
We have Shark Tank in Canada too, Troy. You'll have to check out the Canadian version one day.
Deal.
We have another question from the audience from James. You both mentioned the music industry in your past and current experiences. In your opinion, what differentiates musicians and the overall industry in terms of opportunities and difficulties? Whoever wants to take it first.
Yeah, I can jump. I mean, it's
go ahead.
It's just totally this. It's just totally this. The remote environment just kills it, right? And so I think everyone's been scrambling to say when musicians can't go out and do gigs and shows and tours, like what happens? And because they're not getting enough revenue from streaming per se. So we need to think about new models. We invest in a company called Strayo, which is designed to help more independent artists, emerging artists, gain some revenue streams from doing live streams. But it's hard. I don't have a solid answer here. If someone can figure out that problem, meaning if you have a platform that gets both sides of the market, meaning you get the eyeballs of the listeners, the consumers, the audience, and there's a business model, a sustainable business model that gets revenue to those artists in an appropriate way. I mean, that I think we're all waiting for like that golden ticket.
Mm-hmm.
Yeah, the music industry has been going through, as everyone knows, like a large transformation over the last 20 years, where what was the main revenue model of getting initially vinyl records and tape cassettes and CDs into stores, and people getting in their cars to go to the mall to purchase, like that's not true anymore. I think we've all accepted the fact that now the on-demand streaming platforms are being extremely effective at getting music in the hands and ears of fans, but except for the very top of the pyramid, not very effective at getting people paid. So I think that we're not putting that genie back in the bottle. I think what the industry in general and musicians need to ask themselves is what is now my product? Well, my product and what I'm going to be able to monetize is definitely not like the song I wrote and produced and distributed to Spotify and the others. My product is either my live performances, which I agree is hard to do in this context, but it might be other things like the scarcity of my song being used in a license for a specific purpose. It might be the connection I can have with my fans. Like I see platforms like Patreon do really well, not just with music, but like becoming interesting platforms where the relationship between a fan and a creator is not just built around the content, but built around the conversation, the relationship, and the process, and being part of that process with the recognition that comes with it. So ask yourselves, like musicians and labels and everyone needs to find the scarce aspects, the experiences that people are going to be willing to pay for, and orient their efforts towards these new products or these new ways to monetize the art.
Thanks for that. Yeah, we have one last question for both of your brilliant minds from Nicola. How do you feel about startups that have a long path to revenue but have demonstrated strong emotional reactions from their target segments?
I personally love it. I can go first on this one because I love it. Like I think as investors, when there's a disconnect between measurable engagement, that can be both emotional and time spent in an app or on a site or with a piece of technology. When there's a disconnect between that engagement and its monetization, there's probably where there's room for investment and room for growth. The best case, it's an easy example, but best example was Facebook, because Facebook for a long while was not monetizing. But we're seeing investors, we're seeing people spend hours and hours, both of their time and emotions, poured on the platform. So you knew that once they would find how to monetize this attention, and actually the people giving the attention, there was a lot of room to scale. So it is good, but that, the question like emotional reactions needs to be measurable, I think, for investors to be interested.
I totally agree.
Yeah.
as long as you can measure it and you define what those KPIs are, revenue and traction have proxies. And so that could be anything from, like in the Facebook example, we knew how many new accounts were being created, or how many daily active users or monthly active users were on the platform, and how long they were spending. And I'm sure they could plot that on a graph, and it was going up, 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 right? And so whatever your proxy for traction or revenue is, just be consistent with that and just give the data, give the facts, and then tell a story around that. Similar, sometimes where I get frustrated is, let's say like a regulated industry like pharmaceuticals or medical devices. If a startup or an entrepreneur comes to me and they just say, oh, well, we could never be compared to an e-commerce company that can just flip a switch and start selling their widgets, but I think that they delude themselves into thinking that it's like there's nothing that happens before the regulatory approval. That's not true. There's lots of steps that happen, and all those steps are proxy for some sort of traction. So it can be traction in the form of like users, like the Facebook example. It can also be traction around just the product development steps, meaning, hey, we know that our product needs to hit XYZ specifications before we can take it to the regulating body. Well, then that's your traction. Show that you've hit, okay, we hit milestone 1 on spec number 1. We hit milestone 2 on spec number 2. We hit milestone 3 on spec number 3. That's your traction. So everyone has some proxy for traction. It's just a matter of, thinking internally about what that is for you and for your business, and then communicating that.
Thanks. Yeah, huge valuable insight from both of you. I'm just going to throw this out there, but both of these remarkable humans are on LinkedIn. I'm going to say that you can find them there if you have more questions. Thank you so much, Troy and David, and I'm going to throw it back over to Olivier.
Thank you, Carmen.
Yes, thank you. Thank you for joining us, everyone. Thank you to David, to Troy, to Carmen for the insights, for the really interesting conversation. Next week, we have another event. Don't miss it. April 8th at noon next Thursday. We'll be talking about mixed reality and product growth with technopreneur Bertrand Neveu. So we'll see you there, and thank you for tuning in.